Futures Edge podcast. I'm Jim Urio. As always, Bob Iacino, the brains behind the operation, the co-host, the executive producers here. The first Friday of every month, we do what's turned out to be my favorite show. We have Mike Arnold, who's the chief technical officer and co-founder of Path Trading Partners. And I swear to God, each month I've learned something new. Each month he's either talked me into a trade I was leaning to or talked me out of a trade I was leaning to, and it's worked. I swear to God, I think it's been awesome. Mike Arnold, did I actually say his name? I will say his name now. Mike Arnold, are you there?
I am here, Jim.
Okay, so have you seen the Dead and Company in this latest tour that was just in Chicago? You're not in Chicago, right?
I am in Chicago. I did not get to see them this set.
What have you seen him with John Mayer?
Yes.
How do you think he does?
I was never a John Mayer fan. I liked some of his blues guitar work. I wasn't ever a fan of his pop work, but I absolutely love him with the Dead and Company. I think he's in his complete element.
It's so funny. I have this conversation with my music geeky friends all the time, and we say the exact same thing. His music that he wrote was fine. I didn't dislike it, but I didn't love it by any means. But the thing was special about him is he played a wicked guitar and with the tip of the cap to like blues greats, and that's for me like it's Eric Clapton, Stevie Ray Vaughan over Jimi Hendrix because I like that blues thing. Are you in that same camp?
I love the blues. I mean, my go-to current person to go to for a lot of blues work is Joe Bonamassa. So,
I like Joe Bonamassa too. He's very good. So, who's the greatest guitarist of all time?
Do not.
No, you got to. You can't be wishy-washy.
Who's the greatest? I think there's that. I don't like the broad category because one of my favorite guitarists is David Gilmour.
Really?
Because of the way he plays and the way you can literally feel what he's playing on the guitar. He's not the greatest technical guitarist, but he's the greatest guitarist I think who plays with feeling.
No, and I agree with that. Like, playing guitar, some of them, it's like it's sound and no sound. So, and sometimes people hit their stride, like Mark Knopfler in Sultans of Swing. I don't know if he's as great as a guitarist as that song makes it out, but those are two of the most wicked guitar solos I've ever heard. So I sometimes wonder if it's just someone like a hot hand in basketball. Like he went to the studio that day and like, man, my fingers are good. But that song's got some great solos.
So now everybody under 100 has just turned the podcast off, just so you guys.
Does that happen?
Everyone under 94 years old has now turned the podcast off.
Wait, why do you say that?
Well, because obviously the best guitarist ever was a member of this band.
Oh, come on.
Oh,
really? You're the Kiss Army?
No.
It was Ace Frehley was the best guitarist ever lived.
Okay. You're fired.
You might as well throw Wilcox in there, so at least we get some people under 40 that would watch the show now. But
I was talking to a couple, I guess guys in their 20s who said, because I wear a lot of tie dyes and band shirts, and they said what all we listen to now. I said, what's your favorite bands? They said we love Pink Floyd.
Are they from Williamsburg, New York, where the hipster originated?
But Bobby, my two daughters and their friends and the kids I come in contact with because of them, I think their dedication and loyalty to our music and the half generation before us is stronger than you think. I think they know.
Listen to Kiss is what you're saying.
I'm not sure they're listening to Kiss, but I went to a Little Feat concert a couple of months ago at Chicago Theater, and there was quite a few under 35s there, which I was amazed by. It was pretty cool. Yeah. Should we get to business, or we could just talk rock and roll? It's Friday afternoon. We could just, who cares? I made a little bit of money today. I'm happy. No, as I got to get back to the technical analysis part of it, which Mike Arnold is astounding. So many of the things he said have been just amazing. Mike, do you want to start with equities? Because that's what's on most everyone's mind.
Sure, we can start with equities. And I think we're going to have to do a bigger picture look at some stuff, which I want to do anyways, because we finished the first half of the year. So it's always good to sort of reset stuff. Also, with price action the last couple of days, like 90% of my trades have either triggered or been like, all right, that's not going to happen. So
Yeah, I'm with you.
Mike, I've given you the ability to share the screen if you want to put charts up. So
All right, let me do that right now. So we have the S&P here, and looking at this after the first half, brutal first half, the S&P overall, and now we're sort of still long-term sell the rallies. Definitely still sell the rallies. We'll probably start going into earnings compression. And for short-term stuff, I don't really talk fundamentals, but for long-term, because analysts, I was talking to you the other day about this, Bob, where the worst time to ever follow analysts and earnings projections are either when you're in a recession or just entering a recession, which looks like that's where we're going. So very rapidly. So
if not there already, I will add, and I can prove that when Bobby and I go to the fundamental stuff at the second half of the show, we'll talk about that. But yeah, go on.
So, we're still from a technical perspective, sell the rallies. From a fundamental perspective, sell the rallies, especially with, I think we're going to have some pretty substantial earnings compression coming up. Now we can still get the short-term rip your face off bear market rallies. And the last couple of them have not, we've had the big green weeks, but we've only been able to sustain a rally literally for a week. So I'm still watching longer term for the more rip your face off rallies. What I like to do from my long-term perspective to keep my head clear, especially when we're sort of at an area where we could either break to the upside, pretty much above. If we do break to the upside, the bullish case for a short-term break comes about above 39.50. That just happens to be the high from this week. And then that would trigger a rally. Now, if it's a rip your face off rally, that's where I really like to come up with my higher levels. And my higher levels are 4,077, 42.24, and a level that would blow my mind, but is not out of the realm if something really strange happened with a rip your face off rally is 43.68 area. Now, I come up with these areas and then I like to fine tune them on the daily, but that now gives me a roadmap should we start running up. And my first major target would be that 40.79. Then also
Mike,
on
can I ask you a question before you go on?
Sure.
So that blue moving average is obviously a weekly chart. If we start to move up, will that flatten so quickly that it won't come in contact with that 40.77 resistance, or could it still just mathematically trail down and they kind of meet at the same time?
It'll probably converge in that area.
Okay.
And that's something when I say I fine tune stuff, I will fine tune it with this is the weekly rotation zone. So I would use that, and I'd use short-term daily patterns to help fine tune, but it'd be all around that area. When I say 47.70, is that an exact, like, all right, we have to rally exactly to there and stop dead in its tracks? No, but that gives me an area in which I watch for targets to unfold, because the longer term targets are always stronger than shorter term targets, but shorter term targets can be used to refine the longer term targets.
Hey, Mike, for someone who is stupid enough to just started watching our podcast and hasn't gone back and watched them all, like any good market guy should have done, can we back up and say, so there's the horizontal lines you've drawn across that represent your rotation zones. Can you explain how you've arrived at those, why they're there?
Sure. Again, for the newer people, I use what's called harmonics. They are 8th intervals. Okay, because that's what's statistically tested out even better than Fibonacci. So if people are Fibonacci fans, they should actually look to do some testing with 8th harmonics, and they roughly line up. Like you have the 37.5% level and you have 38.3 for a Fibonacci level. They both have 50% levels. Fibonacci has 61.8, harmonics have 62.5. And if you notice, I just drew my harmonics on here, and you see how nicely the lines line up. And that's
what were those original lines then before you drew the harmonics?
These original lines came from the harmonics. It's just to declutter the charts. See, if I move my harmonics out of the way, you see if I put them back up, they still line up exactly.
Oh,
those are the critical harmonics, those red lines.
Yes, those are my critical harmonics.
Got it. Non-bet.
And why is the 62.5 this most critical? Because if we did get a weekly close and we're looking at a weekly chart above that, then that would statistically start tipping the selling the rallies into buying the dips. Do I expect this to happen in the short term? No, but I have to prepare for all different outcomes and scenarios so I'm not caught off guard.
And what's that level again, where if we settled above it, you'd be more positive that the bear was over?
It's right now, let me give you the pretty much 43.68, 43.69.
Got it. Yeah.
So those are the upside. That's my major upside case. And if you also notice, we use a concept called the rotation zone, which is the 8 EMA and the 21 EMA exponential moving averages. Why? Because when markets rally, those are the areas that they tend to roll over. You see, the last time we got the rally right here back in May, returning into this rotation zone and rotating lower. Now we've just hit it with this week's high and already gone lower. So that's why also, if we get a move above this week's high, 39.50, I watch for the next key levels within the rotation zone to roll over. And as long as it doesn't exceed right now in the rotation zone moves, that's why it's a little harder to do on the podcast, but roughly it's about 41.30 at this point. So as long as we don't get a weekly close above there, I'm still watching for the rollover move, and I'd be keying off of that 40.77 area.
So if you like, we're coming up with your best trade strategy, you think that we could possibly see a pop up to that 40.77, and that's where you'd sell it? Am I reading you right?
That's where I'd be looking for to set up new longer term short trades.
Got it.
And that's only if we start getting above, and I'd at least want a daily close above 39.50. If we don't get that daily close above 39.50, because look, longer term, even short term, we could be lower next week. But I have to prepare for both cases. If you don't prepare for the bull and the bear case, you're going to get caught off guard if the market makes a move you're not expecting.
Hey, I'm going to ask Bobby a question, if that's okay with you. Bobby, Mike mentioned before that we haven't seen the real rip your face off bear market rally that has been a characteristic of bear markets in the past. When you see like all the explosion of options being used, is there a chance that has something to do with it, that the average trader now is a little more sophisticated and might be representing longs and shorts with options and not necessarily get hung with that 100 delta move as it starts to move? You know what I'm saying? Or do I make any sense at all here, or no?
Yeah, the one word I might dispute, and I'm not even really disputing what you said, is sophisticated. There's definitely a lot more options usage in the markets, but I'm not sure I would say that the explosion of options volume equals an explosion of options sophistication.
Amen.
I just think a lot of it may be sort of unintended consequences. For example, some of the selling that we've seen in the S&P going back to the beginning of this year, I think had a lot to do with people having bad options positions on in the first place and selling the actual stocks and selling the futures. So I would just probably, I don't know if I would even say dispute it. I'm not convinced the option sophistication level has reached up yet.
Do you have a theory of why we haven't seen the real ripper?
I think that there's a lot of people still buying the dips and still looking for capitulation rather than getting involved. The funny thing that we keep saying, we joked about it in our last podcast, that we said capitulation and Scott Shelley so many times that we could create a drinking game out of it.
I got hammered.
Yeah, I still am getting texts from people asking me, is the capitulation here yet? So, until that happens, until we get an actual news event or a driver of that rip your face off rally, I kind of think that's part of it. If we don't get the capitulation, we're not likely to get that massive rally that just snaps back in an unexpected way.
Got it. Mike, sorry to have interrupted you there. Back to you.
Oh, no problem. So now to the downside, because this is still the higher probabilities are still to the downside. So the minor would be a break below. We start breaking below about 37.40. I'm watching for the retest of the lows set back in the middle of June. And those lows are at 36.39 area. We break below that. Minor level, 35.72. Major level, absolutely major for a number of reasons. We have a major harmonic coming in about 3,500. We have the 200-week moving average, which is a very important weekly moving average. And that's a simple moving average coming into that. We have a short-term harmonic projection there. And we have the concept of prior major resistance back at August, September, October of 2020 becoming support. So if I could plot out a wonderful trading scenario, which obviously I can't, so the market won't probably do this, it would be a continued sell down to that level. And then we get some kind of either major, more major bottoming pattern or a capitulation move down near that level, and then watch for that rip your face off rally.
And a Fed pivot too, Bobby.
Yeah, that's likely. I mean, look, the average bear market is right around 30%, right? So if you were to go off of that, in the NASDAQ, we were close. In the Russell, we reached it. Now, I would argue that this is not your average bear market because we're not coming off of your average rally. But if you exceed 30% to the downside, you're talking about basically one of the worst stock performances in history in terms of bear markets, right? Back to 2000, basically. So you're talking about the 70 some odd percent drop we saw in the NASDAQ, almost replicating, not quite. So I suspect that if you measured out down to Mike's support level there, that's going to be somewhere around between 30 and 35% lower from all-time highs on the S&P. That's my guess.
Well,
I haven't measured it out because obviously I haven't seen Mike's levels, but what is it?
That would be 27%. And that's
okay,
why
27.25. So that'd be a pretty good guess as to where, what's that second level you've got there, Mike, that light green level? That's probably right around 30%.
This
above that. I'm sorry. Above that. Right there.
This is 33.92.
Mm-hmm.
So
that's probably 30% from the all-time high. Just
let's measure it out right now, because the average now, if we tip into a recession, you remember the average pullback's roughly 37%, and that's average.
Okay, but usually we don't start recessions. What do you got there? 29.44.
That's 30% right there.
Yeah, usually the sell-off. So like that stat you just mentioned, what's that from? Because usually it doesn't start at the beginning of a recession, right?
It starts from the highs from before the recession started to the pullback lows are roughly 37% on average in the S&P.
Now, Jimmy, if you look straight across, look at the 2020, early 2020 highs, and look at that dashed horizontal line that's coming off of Mike's crosshairs there.
Okay.
So Mike draws these levels, and that light green level that he's focused on now that is down 29.44, go all the way to the left and look what it coincides with.
That's the exact high of that move, right? Right before the plunge.
Again, a lot of times people say, well, technicals are just self-fulfilling, but oftentimes as you get better and better with specific use of technical tools like harmonics or something else, you see these kinds of confluences that convince you that your analysis is correct. Now, I want to throw out, when you have a confluence of factors, you do not up your risk. Okay, that's a huge thing, because if a confluence of factors turns a 72% probability trade into an 85% probability trade, right? We still have no knowledge of when that 15% where we lose on the trade comes in. It could be on the one you triple and quadruple your risk on. So we don't advocate. Yeah, we don't advocate upping risk on those kinds of things.
We know this firsthand, right? So, but the reason, one of the things I was getting at in that down move, because my fundamental thesis, and I'll make it quick, is that the Fed is going to over tighten at this point in time, and it's either going to happen in the next, their 75 basis point move then, or the next meeting. And I think there's going to be one more big push down in the stock market before the Fed pivots. And according to Goldman Research, the last 17 times the S&Ps have broke more than 15%, 11 out of those times, it didn't bottom until the Fed pivoted from hawkish to either neutral or dovish. And I think that that's what's going to correspond with this one as well. But anyway, let's
can I ask you a question, Jimmy, real quick? That thesis, over tighten, do you base that versus inflation or versus equities or versus the economic growth?
Yes, to all
Right.
three.
That's
Yeah.
a
So
great
I
answer.
think everything's kind of coming together right now. I think we've hit peak inflation, and I can prove that with, break even, 5-year break evens have just absolutely collapsed. Copper's absolutely collapsed. I think we're going to start seeing different numbers. I think they're still committed to 75 basis points come July, but I think things are changing right now. And I believe I'm on an island too, because so many people told me that I was a freaking idiot on Twitter, but we'll see. Takes two to make a trade.
Yeah, Twitter's not the real world. We should move on. What else should we cover? Because we spent a lot of time in the S&P. So Mike, can we just say this is kind of a proxy for the Dow and the Russell as well? And maybe just look at the NASDAQ?
Sure. I can also just call out the numbers real quick for anybody who wants.
Okay, let's do that.
Let me just, before we wrap up the S&P, let me just give you, if you were to break below this 33.92, and we really broke below those highs that you talked about from Feb of 20, the next major key level, which is roughly a 40% correction, is about 31.62. And that's not based off that 40% correction, because I just measured it out while we were talking. That's actually based off of a key harmonic from the lows, the COVID lows to the highs of January of this year. So that's another key level. Should we just get something really bad and blow to the downside, pay attention to 31.60.
Can I show you one more thing while Mike switched charts?
Yeah.
Cherry's frozen into the ice cube.
Oh, she's a good woman. I'll tell you that.
She's dying in the corner over there.
I'm telling you, I'm in love. My wife went and bought those big cubes because some of my friends are bourbon drinkers. So we have in our freezer, she buys them from Costco and they cost like $1.50 a cube. And I'm like, they're friends, they're not brothers. But anyway, Mike, let's move on. We're going to be here all day.
All right, NASDAQ, real quick. I don't get in any short-term bullish mode until we get a daily close above 12,262. That would take us into the weekly rotation zone. Then I'm just going to give the overall minor target would be about 12.7, and a major target area would be about 13,050 to about 13,180. So those are the levels I will be watching for the upside, and that's only on the close above a 12,262 on a daily basis. Remember, we're also still favoring more downside price action on the NASDAQ. The key breakdown levels for the NASDAQ, minor, if we break below 11,350, we're retesting the about 11,130 to 11,068 lows. The 200 week that I mentioned on the S&P comes in at a minor harmonic level of 10,834. So that's a level, even though it's a minor harmonic level, because you have the 200 simple coming in there, I will pay attention. And the next major support area, if we blow through there, is 10,421 to about 10,580.
Like it. I like it a lot. So basically, the same overall theme as the S&P. We're still in a sell the rally. Yeah, exactly. So do you ever see a time where have you ever seen a time where medium to longer term, you look at the technicals of the NASDAQ and the S&P, and one you see as being a buy the dip scenario and one you see as a sell the rip scenario? No, right?
No, so what I'll do is, we do get a bias shifting. So they might both be in sell the rallies or buy the dips, but then we'll generally have a slight out or underperformance on one. So if whatever one's underperforming, like right now, the NASDAQ on the downside is technically weaker. So on downward price action, you can really get some more amplified moves on the NASDAQ for the time being. And for upwards price action, even though you have more volatility in NASDAQ, it seems to be a lot better trading in the S&P with hitting the levels even better. So the upside play, I'm sort of gearing towards the S&P. The downside plays are towards the NASDAQ.
Got it. When we move along to the next asset, do you have one picked out already? Bobby, do you have one picked out, or can I?
Go ahead. No, you can.
Gold, Jerry. How about that?
Gold.
Gold, Jerry.
Gold.
Gold, Jerry.
That's gold, Jerry.
Actually,
Extra points to anybody who knows what that reference is.
We should do the
Oh.
thing someday in the podcast where people can, it's going to be live and people can comment on the side. That could be some fun.
Yeah.
Anyway. Yeah, I just come up with ideas. I don't actually do shit. You guys should all know that. I just sit here, I drink my coffee, and I talk. But Bob does all the work. But anyway, go on.
all right, gold. We actually have a potential, and I'm going to stress this, potential bullish pattern. Why? Because gold has been acting like crap, but we do have a potential double bottom play, and that would need at least a daily close above 1840.60 in your front month futures. And what's so interesting about that is if that triggered, then I have also my thick red lines are my harmonics, and these little shading areas are the targets for the double. Well, if you notice here, the first double target is about 1931. The harmonic level is 1934. So I have a wonderful upside target there. The next little target for the double was about 1954, and I have a minor harmonic at 1959, and then the full target is 1980, and I have a major harmonic at 1985. Just so happens that a bunch of stuff lines up, which again probably means that this gold will go lower because that won't trigger, because it just lines up too perfectly.
What needs to trigger, and this is important to me because this is my trade, what needs to trigger, to reiterate?
I need a close, a daily close of 1840.60.
Got it.
Now, to the downside, again, we got to analyze both sides, especially since gold's in an overall huge consolidation pattern. Also, by the way, there is a massive double topping pattern, which again doesn't have to trigger, but if it does, then watch out below. Minor levels, if we break below 1785, we got 1748, which also comes in contact with this little prior support shelf from back in August of 21, November, that was tested multiple times. And that's from a harmonic projection down. So that just corresponds with actual price action with the harmonics. And then the major support area is 1711 to about 1696. What you don't want to see if you remain anywhat long-term bullish on gold is a close below the March of 21 lows, which come in around 1673. We get a close below there, then it's a major topping pattern has just triggered.
Got it. So my trade is going to be, my stop, I think you're going to like at 1775. That's a good place for a stop, right?
If it's a bullish play.
Yeah, that's what I mean, for a bullish trade, right? Yeah, because it's going to be, but again, that's for later in the show. But thanks, please go on. This is awesome.
And by the way,
I do have a question about gold.
What's interesting, just for you can take this for what it's worth with your bullet, and I don't know what your trade is. However, I have an aggressive percent B. It's based off of Bollinger Band system. Aggressive percent B buy signal on a close next week above today's high at 1810.30, and it could be front run intraday, which is also then above this short-term little resistance becoming support, or support becoming resistance right in here. So then there's a very short-term bullish trigger. So you can tie that into your.
So you're going to like my trade because my stuff lines up correctly with yours. But here's my question about on the very short-term basis. Today it broke through that 1800 level and rejected those lows to come about it. To me, that was the first in a line of signals that there might be some short-term strength. Does something like that matter to you?
Yes. And it just so happens, I mean, I need to wait either intraday for a break above that level and a retest of today's high and a roll up move, or preferably a daily close above. This is Friday, July's first high, and then we make that little short-term run. And if it can get some legs, because there is a fair amount of buying pressure that we've seen down between the 1785 and 1800 level. If that turns into a more macro rally, then we could roll that position longer term, or at least part of that position, into the potential double bottom, and then go for those higher prices.
Love it.
Hey, Mike, were you planning on staying on and critiquing the trades?
I can.
Jimmy, why don't you just give your gold trade since we're on the chart?
Okay, good. So here's my trade, and I think you're going to say to raise my stop in by just a hair. Where did we close? So I don't know if I've actually triggered it yet because I'm in front of the camera instead of this. So where, I don't know where we are.
1808.80.
Okay, so my stop in is 1810 with a target of 1900. As soon as we're done this, I'm going to go back and decide if I'm actually putting it on. The reason I might not put it on, as you guys know, in my medium term portfolio, my inflation hedge portfolio, I do got a lot of gold. So sometimes that clouds my trading thesis if I have it as an investment as well. But 1810 with a target of 1900, as Mike said, I think I may raise that if I start to get some movement on it, and a stop placed below 1775. Thoughts?
Go ahead, Mike.
Well, I like the entry. Definitely like the entry because of this bottoming pattern. And what did you say your stop was?
1775.
Yeah, because if you do break that level, I'd be back to, okay, let me just see something with the harmonics real quick on the short term. I don't know how it would play out in risk reward, and this is getting a little nuancy, but I'd have my stop just below 1771. So we're in the vicinity of the same area. And to the upside, you said target of 1900,
but 1900 even, but I plan on changing that if it starts to run and, like, you know, trim and trail, whatever that expression is.
Yeah, the first target, which I would, you know, because if it actually got here, it'd roll into that double pattern, but the first target is about 1895.
Okay.
Based off the harmonic, so just in front of there. And if this did run earlier, I like to raise stops. Like a key level for me to raise stops before you even got to that level would be about 1859.
That makes sense. I love it.
So
Okay,
I can fully get on board with that trade because you have limited downside risk and you have a potential, you know, multiple potential patterns unfolding to the upside.
Good. Love it. Okay, good. What are we going to next?
What do you want?
Let's do
Bobby?
Swiss franc because it'll lead into my
Sure.
trade.
What do you want?
Good.
Swiss franc.
Swissy. The Swissy. All right. Swissy. We have a pretty substantial, massive double bottom pattern on a weekly basis. It did technically in the futures trigger last week. The only negative side to this is cycles are at the top on the weekly. It triggered also on the daily with cycles at the top. But here's one of the things, and this is a little nuanced. I think some people who trade futures, especially in FX, if it does not, it is not triggered on the spot market. And I've done a lot of research. When something triggers in the futures but does not trigger in the spots, the probabilities drop until the spot does trigger.
Interesting.
So that's not to say it can't work with cycles at the top and from a futures aspect, it's being patient on a potential pullback. And then if that spot does trigger, executing in the futures market for the run up play. And the targets. And by the way, also when a double triggers, and you see how it just triggers here right in front of the blue line of the rotation zone and didn't close above it, that does slightly lower the probability. So that's why I am cautious with this trade to the upside. But once the spot triggers, you can even get a better entry if we get that slightly bigger pullback in the futures. And then we have nice targets to about 107.20 area, then 108.20 area. And then if it really runs 109.40.
So,
And Bobby,
really
want to give you a
quick.
trade?
Yeah, really quick. Obviously, Mike and I are, we do price action analysis in a very similar fashion. And if you look at the daily chart again, I put this one on the pullback. All right. I didn't get as good an entry as I'd liked. To be honest, Mike kind of tipped me off that this had triggered in the futures. By the time I looked at it, I could have gotten a much better entry on this than I did. But I ended up entering the long at about 104.49. So I'm long the Swiss franc right now. Quick side note, if there were not micros, I wouldn't do this trade. Because again, if I had to do this in the full size, the probabilities are reduced enough that I wouldn't want to put that much risk on, quite frankly, with this trade. Mike already mentioned a couple of ways that the probabilities reduced, but I really like that the daily rotation zone is where the pullback went to, as well as obviously the entry trigger. That's where the pullback went to and then came and basically closed back right on it, not quite above it. I would have liked if the rally up today would have closed above the trigger price, but it didn't. Anyway, but there's good risk reward on this. It's about 1.4 to 1 reward to risk. So I'm long for about 104.49. My stop is about 108 even. I can even put it a little bit lower than there, and I might. And my target is 108.26, right in between the two targets that Mike talked about. Now, on this one, I will aggressively trail my stop simply because of all the things in the way on the longer term charts. And Mike mentioned that it didn't trigger on the spot. I've seen the same thing. My research was not in depth as his, but there's a high probability when it triggers on the future that it will trigger on the spot. But I'm telling you, those probabilities don't reach 85%. It's lower than that. So if it triggers on the spot, I'll feel a lot better, but I will aggressively trail a stop on this one if we get any move higher off of this long wick that we had today.
Do you two work together? I know. Do you ever put on a trade that you don't have Mike go over, give you his technical analysis on it as well?
Well, this one, right? But
so
you know, I usually
100% of the most recent ones.
Look, if this one is if the normal probability, and I'm making this number up, Mike has it in his research somewhere, but if the normal probability of a daily double that's triggered on the futures but not on the spot is 62%, then it's still good. And whereas the other one might be 68 or 70%, which is obviously better. Mike is much more disciplined than me. I will tell you what, in the equity markets, the answer is no. I won't put one on unless, and I always bring this example up, but Chipotle, when I was still living in Chicago and Chipotle had that E. coli scare, I don't remember where the stock was, and I'm going to make these numbers up. Stock fell from 500 to 300. Again, I'm making those numbers up, right? And I drove by a Chipotle off of Monroe, and I think it's Canal in the city there. And the line was out the door, and I'm like, Mike, we got to buy Chipotle. I mean, the line's still out the door, and he's like, not yet, not yet. It fell like another 60%.
Right.
So I've learned my lesson enough times.
No, and the reason I asked the question is because I think Mike is a very, very talented technical analyst, like I said, and I'd love to everyone submit to him and say, talk me out of this. You know what I mean? And if he can't, because again, you know, I mean, you and I are pretty hard-headed people when we want to be as well. It's not the easiest thing in the world to talk someone out of it, but I'd like to give someone like Mike a chance. So I think having access to him is very, very cool. I
will say this in that, and Mike's going to smile again. If it wasn't for the micros, I wouldn't have put this one on because there's too many things going against it. If I had to do this in a mini or a full size, I wouldn't do it. With the micros, I can trick it down. I didn't even mention the reward to risk on this one, $336.25 per contract versus a potential reward of $471.25. I can live with that if this one's wrong. I also
no doubt about
I also think fundamentally there's going to be a little bit of a dollar pullback, which would play well to this.
That's why my next trade is the Canada trade too. But Beck, I didn't give my risk reward in the gold trade too, which is irritating because there was something interesting about that as well. If I went to my target, it was 900 to make and 350 to lose.
They're almost 3-1 on that.
Yeah, 3-1. But the reason I was kind of proud of that stop level, because that to me was more important than even the target. The stop kind of defined itself, in my opinion, below that 1800 level. Yeah, and usually is. And that's one of the points I wanted to hit that I totally forgot, and I apologize. Sometimes you look at a chart and go, wow, I see where my stop should be exactly. And
Mike, real quick, can you measure out the double so I can show why I put my stop where I did?
What was your stop again?
It's below the 37.5. My stop's 108. I'm sorry, 101.8.
Good.
Yeah,
Okay. Yeah. I was wondering.
I was like 108.
How much of that drink did you drink? 108.
Yeah. I was
Sorry,
like
1018.
1018.
The 37, if I'm correct on that, is like 108, 1018 something.
The 37 is 1027. The 50 is 102.
One more. What's that?
The 50 is 102.21 roughly. And the key area on a closing basis, I love to put, hold on, I had it slightly off. Hold on. So you had 1018.
Yeah. So I went right
You
below
were
the
below
50 there. I'm sorry, go ahead.
You're between the 50 and the 62 and a half.
Right. Now also check where the low of that rotation zone turn is, where the low of the 8 is.
That's 101. Yeah, that's roughly 1016.
Okay, I need to get below that.
So really the tipping point is right now, because if you have a daily close back below 1014, then it favors returning to a triple bottom statistically.
Okay. All good.
Can we, is there a chance we can do, what's called Canada next?
Yep.
And I really, I have to confess that me being along the Canada is more fundamental than it is technical, which is extremely unusual for me. Did we close? We're the futures still trade to the regular time, even though it's
Yep.
4th of July weekend, right? Yeah.
It's normal close, then it's the reduced trading on
Good.
Monday. So yeah, all right. I got the Canadian up.
You want me to tell you my trade first, and then you'll tell me how stupid I am, or no?
No, tell me your trade.
Okay.
Don't presuppose stupidity.
No, I know. I've been around the block. So here we go. So buy at 0.7746, current the level where I last left it. Target 0.7950 in the upside. Now I chose my stop at 0.7620 because it's below those two lows. I thought those two lows struck me as a rock solid bottom, and I wanted to put my stop below it. This trade would make $204 if you bring it all the way up to $79.50, and it loses 126 if you're stopped out at 0.7620. Thoughts, Mike Arnold?
All right, all right. I got your stop. Now give me the targets again.
Target is 0.7950.
0.79.
So not new highs.
50. Oh, okay. Right about here. Okay. All right. Let's see. Let me just take a look at the weekly because we're in a overall consolidation pattern. Coming off the 200 simple with cycles trying to bottom on the weekly. Could have a bit more to run back down. I think your stops, we could see another pullback in prices as we get the cycles bottoming on the weekly with the daily at the top and rolling over. But fundamentally, this is a very strong support area, about this 76.40 to between that and about 76.80. So 0.764 to 0.768 is a very strong support zone. So you could see you could see another retest of this area before it breaks to new highs. What's interesting, I want to check something out. And I'm just doing, if we did pull back there, just curious about something. So if we did pull back into this area again, you would have a full-blown double bottom pattern, and your full target would be 79.57. So even if you pull back and you don't really, I mean, your stop where it is, if you get momentum below the 76.40, that double won't trigger because it'll be blown out of the water. And you'll get some serious downside momentum to that. So your stop's in a good place. And that could be just an early entry on a stronger pattern upside. Now, especially if once this gets above about 78.20, then you really start you don't fully tip it the odds to the full thing if this double does not manifest, but you start even tipping the all right. So if we take the potential double that's in my imagination at this point on the chart, because we haven't pulled back, if that doesn't happen and you start getting above about this about 78.20, then we should start seeing some upside momentum and stop raising target. If it closes above 78.60, you are really golden, because statistically then you favor 79.40 being the target and you're just on the other side.
So tell me this, if I came to you and said, fundamentally I want to own Canada for some reasons that hopefully we have a little bit of time to talk about, would you have told me that my entrance at 0.7746 is too low and I should wait for something else? And if I'm supposed to, what would it have been?
This would see, for me, I wouldn't, since I don't have an entry here, to me that either I'd be waiting for a lower price around 0.7690, or I'd wait for the breakout in a daily close above 77.80.
Okay, so only 40, 50 ticks higher than where I am right now is where the daily close would need to be in. So we to me, in my mind, we're like an 85% matchup on this trade. Is that fair?
That's fair. And you know what? Even if it gets to pull back, you could just pull back this area, form an even stronger bottoming pattern, and you just
buy more
early on an entry.
The beauty of the micros, as Bobby said. And one thing I wanted to mention too, that I love that you mentioned, Bobby, is both Bobby and I have been in the business for 35 years. I know, Mike, you're a little younger than us. And we come on and we talk about trades, and we're addicted to trading probably, and we do it all the time. That doesn't mean we're throwing around 1,000 lots in the bonds. You know what I mean? I know old traders and I know bold traders. I know very few old, bold traders. And that's one of the things I hope we get across. Bobby, that's important, don't you think?
Yeah, I mean, again, this Swiss trade, I don't need to go home with a Swiss franc long. It's just something I have an
having some
opinion
fun,
about.
man.
And again, if it wasn't a micro, it would not be on right now. It just wouldn't. So
Yeah,
it's a really, really good set of products for people to kind of get their feet wet. The thing that people don't realize with trading is that once you have your discipline down, you have your process down, it's really just a matter of adding zeros. It's not any different. Mike and I have talked to newbie traders for years and years and years as partners. One of the things we always tell them is, your risk is the most important thing. And as long as you're within your risk parameters, we always talk about our risk and our reward on these. And you'll find that unless it's an options trade, the risk is never larger than the reward. And usually we try to keep the risk really small per contract so that it's a trade that people can relate to. And again, on the Swiss trade, some $300 of risk, I have one micro on. So
yeah. And I'm 57 years old, been doing this for 35 years. I plan on doing it until my eyes don't let me see the computer and my hands can't move the mouse. I'm going to do it forever because I like it. But I don't need to make $100,000 on a trade. I've made some, and again, I'm not trying to boast, but I do this because it's part of my job and I enjoy the hell out of it. But I don't need to try to hit home runs. And the people I've known over the years who did try to hit home runs, well, they're, selling perfume on the bridge, which, by the way, that actually, that's another story for another day, but it was a big trader who then was selling knockoff perfume on the bridge over Whacker. So, but anyway, I'm not trying to make
when the one guy
him.
jumped off the bridge with the feather duster, you remember that whole story?
I do, but what was that again?
That was a guy no, he didn't lose a bet. There was another trader who had done really, really well on a really volatile day. And the other guy had a margin call he couldn't afford. So his friend agreed to cover him if he stripped down, put a feather duster in his nether regions and jumped off the bridge at Madison, and he did it. The funniest part of that is a bunch of us are watching. He's stripping on the bridge on Madison, and people are running in other directions, seeing this guy just strip. Right, this guy just jumps on the bridge, taking his clothes off, and all of a sudden he jumps in, and he comes up, and one of us, it wasn't me, but one of us yells out, "How far did it go up?" And he puts his fist in the air and goes like this. Anyway,
happy Friday.
Hey, can we look at crude oil? Because I want to say that I like the technical aspects of your trade, Jim, and I do think the dollar is going down, but crude oil is part of the reason I wouldn't want to express this opinion in Canada, simply because I'm for the first time, probably in about, well, let's say since about December of last year, I'm negative crude oil in the short term. And I've been positive crude oil for quite a long time, just looking for good pullbacks to get in. And in part, it has to do with the rotation zone turning down. And we kind of like to
Can
draw.
I interrupt you real quick? For
Yeah, go
people
ahead.
who haven't heard us beat this drum before, the reason Bobby's conflating Canada and crude together, Canada's long historically been a petro currency and has gone because it's its major export to the U.S. Where the crude goes, generally Canada has a pull in that direction. Sorry to interrupt you, Bobby.
Right.
In
No,
case
that's
people
a
weren't.
good point to
Yeah,
make. It's got a very solid correlation.
yeah.
The Aussie, the Kiwi, and the New Zealand are commodity-based currencies in theory, and they have high correlations to. Now, I'm not to commodities, and I'm not short crude oil here, but we had a pullback into the rotation zone, and often for entries, we'll draw a sort of best fit trend line angled up into the rotation zone. Mike, you could kind of see where I would have drawn one right now. Again, I'm not short it for various reasons, but if you draw a slightly upward sloping trend line, sort of a best fit trend line off of those 4 green candles going up into the rotation zone on the daily on crude, you'll see that we then broke that trend line and head lower, which leaves me sort of neutral to negative. Also on the weekly crude oil chart, we've got a really sloppy potential double top. That's very, very sloppy. I didn't measure it out to see if it fits the parameters.
It does.
But this could, if there's some sort of fundamental reason for it to happen, could certainly send crude oil. I wouldn't expect it to get down in the 60s, but it could head down to the 80s, 70s or 80s, which I think would certainly pull the Canadian dollar along with it to a certain degree.
That makes some sense, and I will watch that for certain.
You want to do crude while we're on it, Mike?
Yeah, sure. So on crude's sort of a mixed bag right now. From statistically based off a close back on June 23rd, we should at least go down and retest into the 90s, which would be major support. The only thing that could change that is we do have a potential, this low today on Friday, July 1st, did just meet the minimum criteria for a potential double bottom. So I'm staying in choppy to bearish mode for the time being, especially if we break this longer term daily trend line. Then I will really target those, something at least starting below $100. All that's off the table if we a daily close above 114.05. Then I'm the targets are 118.79, 121.06, and a potential return to the highs back on the 14th of June, 123.68, and the full double target is, let's see, 123.80. So right there. But the first two are the higher probability targets on that trade. But that's only on a daily close above 114.05. If that doesn't happen, I'm choppy to downward bias.
Okay.
I need to point out I did a Yahoo Finance interview today, and not today, I'm sorry, this week. And they asked me if there was going to be any relief at the pump. And my answer was, I don't think there is. And my answer was also, I still think the ultimate target for crude oil is up in the 130s. I don't think that 130.50 high was going to hold. That was prior to this little rotation down that we've had over the last couple of days. And still my long-term fundamental base case is for higher crude oil prices, because I just don't think there's a solution to this supply demand. But when I start to see these technical things potentially happen, I don't put on a trade, but I start to look for fun. And this is one of the things, a lot of guys have fundamental views and then they look at the charts and the technicals. I actually do the opposite. I look at the charts, I talk to Mike, and then I say, okay, what's more likely to happen? What's the fundamental reason why that might happen? And that tends to be my opinion. So it's a weird thing. Like some people might think of it as cheating when my fundamentals are based off the price, but I'm looking at the price and saying, okay, there's the potential here. It's small potential, but there's a potential for crude to get down to $62 here on this particular chart we've got up right now. What would make that happen? A recession, loosening of drilling and leasing regulations in the US, and potentially suspension of the Jones Act and an agreement of OPEC plus to pump more and demand destruction based off the recession and the end of the summer driving season. A lot of that can play out. Not my base case, but that's sort of where I'm coming from in that stance.
I love it. That's interesting.
You know, what's sort of funny, Bob?
What?
If we did trigger that double, I mean, look where the 200 week is, and look where the prior major. See all this stuff.
They line up.
This is why you back up the truck. You know, you just add all the probabilities together. You're at 200%.
Hey, can you explain real quick? Several different times you've talked about triggering a double bottom. Can you explain that to people who might not understand what you mean by that?
Yeah, this is critical.
Okay, there's two things on double tops and double bottoms. Since we have a double top on the chart right now, we have one top that was from the week of the 7th of March. We have this other top, which was between the weeks of the 6th of June and the 13th of June. We have the bottom, the little base from the 11th of April. What the pattern is still what we call a potential pattern. Why? Because it's not confirmed until you trade below the 11th of April's lows. And on a weekly basis, in order for it to trigger and the probabilities to shift up drastically, and I'm talking more than 12 percentage points, you need a close below 90. And on this chart, it would be 92, 93.
Not just a
Sometimes,
trade.
and I like this.
This is a weekly chart.
Yes.
Yeah.
What people, because I do this all the time as I run the daily live streams, people say you put on a potential topping trade and the markets went up. And I said, yeah, it was potential. It never even confirmed or triggered. Just like this is a potential double top on crude. We could skyrocket and blow through 130.50. Then it would actually turn into a triple top, which favors a continuation of price action. So just because there's a potential setup on a chart, it might never trigger. It might disappear because, you know, something happens, we rocket to the upside, and then the chart pattern is invalid. So that's why I say, you know, just because there's a potential, it's analyzing the market to come up with the different scenarios. And you might have a bullish and bearish scenario, and one of them's probably not going to trigger. So if it doesn't trigger, you did the analysis, you came up with your game plan, and then it's like, all right, that trade never happened. So next, it was just practice with my analysis.
Okay, that makes good sense. Let's wrap it, boys. We've been talking a long time. I'm getting a little sleepy. You guys?
I'm going to say this really quick in terms of potential, confirmed, and triggered.
Oh, good. Yeah.
Okay, the reason these are important, I always think of it in terms of weather. Okay, there's the potential for rain, right? Hasn't rained yet. Okay, there's rain clouds off in the distance. They haven't even approached you yet. A triggered pattern would be the rain is falling. Okay. So you don't walk around with an open umbrella just because you see rain clouds, just because there's a potential for rain. You carry an umbrella. People need to realize that, like Michael
Bobby,
said,
you saw that Canada chart, which had a very distinct double bottom. So what does that mean?
Pull that up, Mike.
On the daily.
That is a potential double bottom. Okay. It's not confirmed because you've not traded above that peak yet. Okay. And the peak is right there where Mike is at.
This one we don't have a potential yet.
That's on the daily, isn't it, Mike?
On the daily is what I was talking about.
This isn't a pullback far enough yet.
Yeah, that hasn't pulled. You know where we could look at it best is the yen. Let's pull up the yen and we'll talk about a double bottom that is potential.
Right here.
Okay. So see this?
Okay.
Now there's main characteristics of a double bottom. Number one, it's a reversal pattern. So there has to be a down move that it is reversing, right? Mm-hmm. You can't just have two bottoms and say it's a double bottom. If there's not a down move prior to it, it's not a technical double bottom. It's just two bottoms. Okay. Otherwise, what's it reversing? We all know doubles are reversal patterns, right? If there's not a move prior, what's it possibly reversing? So this particular case, Mike, what is the peak there?
The peak is from June 23rd at
what's the price? Can you see it?
0.0074910.
Okay, so 74.91. right?
Right.
In order for this to be a confirmed double bottom, it has to trade above there.
Got
In
it.
order for it to be a triggered double bottom, it has to close above there.
Okay. I
So
love
there's
that.
potential, confirmed, and triggered. Triggered is when you look for an entry where risk reward is proper, once it's triggered.
Okay.
Now, if Mike
Good,
is
man.
Mike is very strict about this. On Path Trading Partners YouTube channel, he does daily webinars, 2 and 3 a day. I appear on 2 of those a week, but the rest are all Mike, and it's all technical analysis, and there's nothing to buy. You don't have to buy anything. He doesn't sell anything on there. He just does analysis. And he'll say, we have a double bottom here. That means it is no longer a potential, it is confirmed. And then he'll say, we have a triggered double bottom. That means a trade is possible. So he
Love
either
it.
says potential, double bottom, or triggered double bottom. Those are the 3 types.
Yeah, and
Very
just
cool.
to say, so there are ways also to, like, if you're a more active trader, let's say we broke above that 749.10 with some momentum intraday, could I then be a buyer of the yen futures and then say, you know, if we close above it, I'm holding it for the trade. If we don't close above it, I'm out. You know, so there's ways to play it before it's technically confirmed, but you don't want to just say, look, I have a chart on the pattern. Am I buying it today? No, because it's not even, the pattern could disappear. If we rolled down
Right.
next week and came back
Forget
down
about
to
it.
this 73.57 area, the trade is no longer even valid. It's no longer even a potential double bottom. It's now a triple bottom, which favors a continuation trade.
I love that. Okay, that's good. Again, as always, I learned a ton on this. You literally, very rare than the last 25 years that I meet someone who definitely changes the way I look at things. And Mike, you have done that to me, and I appreciate that very, very much. Bobby, got anything to add to finish? What are you doing tonight? You going out?
Yeah, tonight we're actually going out. My wife works for a liquor distributor, and there's an end of quarter party. So there will probably be
cool.
some liquoring.
Very cool. We're gonna have a party on our driveway. Mostly, there's a woman across the street who's like 85 years old, and we noticed she doesn't get out much. So we're having a party so she can walk over. By the way, it's my wife who's the saint, not me.
Yeah, dude, you're
But,
not
so
kind at all. How did that
No,
happen?
not
You're
kind
a
at all.
kind
But I
person.
married someone who's very kind. So as a team, we come out to be slightly above average, I think. So I take the credit for that. And Michael, when I go to the bar tonight, I'm going to play. I'm thinking Bertha and Eyes of the World, and think of you as I play it. Any other Dead song I should play on my playlist?
Oh boy, what boy? Oh.
Try a little Shock Me by Kiss.
Oh.
If you can find it.
I'll throw that in too.
Play Road Jimmy for me.
Road Jimmy, I will play that. And it's funny for me, my relationship with the Dead, I only listen to the Grateful Dead in the summer, and I can never figure out why. It's probably just triggers memories of playing hacky sack and throwing a frisbee around when I was 14 years old. But in the winter, I never listened to the Dead, oddly.
Mike, where can people follow you?
They can go to YouTube and search for our YouTube channel, Path Trading Partners. They can follow us on Twitter, Path_trading. Those are 2 of the best things. Or they can go just www.pathtrading.com and check out the website.
I've got a last comment on your guys' taste in music. You ready?
Yeah.